Markets climb on endless optimism. Prices hit record after record. Investors feel the surge. Confidence runs high, but quietly, away from the headlines. Another process begins. Corporate executives and well-connected investors start adjusting portfolios. They reduce concentrated holdings. They take profits after years of appreciation. They move toward greater balance. These decisions rarely come from crystal balls. They arise from practical realities. Direct access to internal reports. Early views of shifting fundamentals. The need to diversify wealth tied to one company. Over decades, history has shown clear patterns. During prolonged bull markets, insider selling volumes typically increase. Shares from initial public offerings become freely tradable. Early investors and founders gain liquidity. When market conditions change, those earlier moves often prove protective. The difference becomes visible between those who repositioned and those who stayed fully invested at the highs. This is the documented record of positioning in financial markets. How information advantages and prudent timing affect wealth preservation. How notable clusters of sales frequently appear when valuations reach extended levels. To trace these patterns properly, we need to travel back in time to the great boom of the Roaring Twenties. America in the 1920s experienced explosive growth. The economy expanded rapidly after World War I. New industries emerged everywhere. Radio broadcasting reached millions. Automobiles filled the roads. Electric appliances transformed homes. Stock prices reflected the excitement. The Dow Jones Industrial Average rose nearly fivefold from 1921 to 1929. Margin borrowing allowed investors to buy shares with only small down payments. Speculation became widespread. Ordinary citizens joined the market in unprecedented numbers. Shoeshiners gave tips. Taxi drivers shared hot stocks. The mood suggested permanent prosperity. Yet several experienced figures began withdrawing gradually. Bernard Baruch, the renowned financier and advisor to presidents, systematically moved assets into cash and fixed income securities throughout the summer of 1929. He later described sensing excessive speculation. Other prominent names followed similar paths. Members of the Rockefeller family reduced equity exposure quietly. Certain banking leaders lightened positions. Albert Wiggin, chairman of Chase National Bank, took an even bolder step. He established short positions against his own bank's shares in 1929, profiting directly as prices declined. The turning point arrived suddenly. October 1929 brought panic selling. The market lost almost half its value in weeks. By mid-1932, stocks had fallen nearly 90% from their peak. Individuals who had scaled back earlier preserved substantial capital. Many everyday participants, fully committed during the final advance, endured life-altering losses. The episode laid bare important differences. Professional networks delivered earlier warnings of risk buildup. Leverage across the system had become dangerous. Prices had detached significantly from underlying earnings. Congress responded with major reforms. The Securities Act of 1933 and the Securities Exchange Act of 1934 established disclosure requirements. Insider transactions gained oversight. Public confidence aimed to be restored. Yet the fundamental dynamic endured. Information still reaches some participants ahead of others. They adjust accordingly. After World War II, markets rebuilt vigorously. The post-war boom created new wealth. Technology and consumer goods led advances. By the 1990s, the internet sparked another transformative era. Dot-com companies attracted enormous capital. Startups went public quickly. Many operated without traditional profits. Valuations soared to unprecedented multiples. The Nasdaq Composite Index surged over 400% from 1995 to its peak in March 2000. Insiders monitored developments at close range. Venture capital lockup periods expired across hundreds of firms. Billions of shares became eligible for sale. Activity escalated dramatically. Executives and early backers sold more than $43 billion worth of stock between 1999 and mid-2000, roughly double the pace of previous periods. In the months immediately before the top, insiders sold approximately 23 times more shares than they purchased. High-profile cases illustrated the magnitude. Philip Anschutz realized close to $2 billion from Quest. Gary Winnick secured hundreds of millions from Global Crossing. Numerous founders and CEOs followed suit across the sector. When the reversal struck, technology stocks collapsed sharply. The Nasdaq dropped more than 78% by October 2002. Trillions in market value evaporated. Retail investors who entered heavily near the peak suffered the most severe declines. Those who had realized gains earlier experienced markedly different results. The cycle demonstrated continuity. Information proximity influences decisions. Broader participation often peaks later. The patterns carried forward into the 21st century. Economic cycles continued. Expansions encouraged broad participation. Valuations rose substantially. Insider responses evolved accordingly. The early 2000s saw rapid growth in housing and credit markets. Home prices advanced steadily for years. Lending standards relaxed significantly. Subprime mortgages expanded quickly. Complex securitization packaged loans for global investors. Leaders at major financial institutions had direct oversight. They reviewed portfolio compositions regularly. Risk models, default trends, liquidity conditions. Research conducted after the period revealed distinct behavior. Between 2005 and 2007, executives at banks with higher subprime exposure sold considerably more personal stock. Volumes averaged 30 to 45% above those at institutions with cleaner balance sheets. Chief executives and chief financial officers drove much of the activity. Their transactions aligned with internal assessments of mounting vulnerabilities, rising delinquency signals, over-reliance on short-term funding. When the crisis materialized in 2008, the impact proved severe. Lehman Brothers collapsed. Bear Stearns required rescue. Major indices fell more than 50% from late 2007 highs. Individuals who had trimmed holdings in advance limited personal damage. Broader shareholders, pension funds, and employees often faced steeper declines. The episode reinforced the role of information timing, not guaranteed accuracy, simply earlier exposure to emerging pressures. Markets eventually stabilized through coordinated policy actions. Central banks lowered rates dramatically. Governments provided guarantees. Recovery gained momentum over the following decade. Technology companies once again took leadership. Smartphones, cloud computing, and digital platforms drove gains. Major indices reached successive records. The year 2020 introduced unprecedented disruption. Global lockdowns halted activity. Stock markets plunged sharply in March. Policy responses arrived swiftly and at massive scale. Fiscal stimulus totaled trillions. Central banks expanded balance sheets further. Interest rates remained near zero for extended periods. Asset prices rebounded vigorously. Many sectors achieved new peaks within months. Technology and growth names led dramatically. Valuations stretched in several areas. Price-to-earnings ratios climbed well above historical averages. Market concentration increased. Insider patterns resurfaced in response. Selling activity picked up in segments, showing rapid appreciation. Moving into 2024 and 2025, the advance continued. Artificial intelligence themes dominated headlines. Large-cap technology firms accounted for disproportionate index gains. Insider metrics shifted noticeably. Buy-to-sell ratios declined across the broader market, falling below long-term medians. By late 2025, overall insider buy-sell ratios hovered between 0.28 and 0.32, compared to historical averages closer to 0.40. Chief executive ratios showed similar caution, often dipping into the low 0.40s. Specific transactions drew attention. NVIDIA board members and executives sold shares worth hundreds of millions near all-time highs. Broadcom leadership realized substantial proceeds from exercised options. Meta Platforms management conducted programmed sales under regulatory plans. Amazon founder Jeff Bezos executed large predetermined disposals. Many trades followed Rule 10b-5-1 protocols, established in advance to avoid impropriety claims. Yet execution occurred during periods of exceptional performance. Independent research firms tracked the trends. Reports highlighted elevated selling clusters, notable especially in high-multiple sectors. While individual motives vary, collective shifts often accompany mature bull phases. Not every instance precedes major declines, but correlations appear consistently across cycles. Economic backdrop added context. Interest rates began normalizing after aggressive tightening. Inflation moderated, yet remained monitored. Earnings growth concentrated heavily in select names. Executives pursued personal diversification, locked in multi-year appreciation, managed tax and liquidity planning. At the same time, retail and institutional inflows stayed strong. Passive index vehicles continued purchasing shares systematically. The contrast echoed earlier eras. Information proximity informs decisions. General market participation frequently peaks later in cycles. These observations span generations, from 1920 speculation to 21st century technology booms. The underlying dynamics show remarkable persistence. These recurring observations across nearly a century invite deeper consideration. Why do similar positioning patterns appear in every major cycle? What practical insights can they provide for investors today? The answer lies primarily in the uneven distribution of information. Corporate leaders receive detailed operational updates on a daily basis. Revenue pipelines, customer behavior shifts, supply chain disruptions, competitive threats, regulatory changes. They also manage personal finances tied heavily to company stock. Equity compensation forms a large portion of executive pay. Over time, this creates concentrated exposure. Reducing holdings becomes a standard risk management step. Diversifying into other assets, funding lifestyle or philanthropic goals, preparing for retirement or succession. When multiple executives across an industry act in concert, it often reflects a shared reading of the environment. Valuations may have reached levels that encourage caution. Growth expectations already priced in aggressively. Yet markets have always shown remarkable long-term resilience. No single peak has marked a permanent end. Corrections, even severe ones, have consistently given way to new advances. The Great Depression tested the system profoundly. Recovery required years and major policy innovation. The dot-com unwind erased trillions, yet paved the way for today's digital giants. The global financial crisis demanded unprecedented intervention, but led to one of the longest bull markets in history. Each episode ultimately rewarded those who maintained broad exposure over full cycles. Patient, diversified participants compounded wealth powerfully. So what does this mean for you as an individual investor? Most people do not sit in boardrooms or receive quarterly briefings directly from management. Access to real-time internal data remains limited. Attempting to replicate precise insider timing has proven extraordinarily difficult for outsiders. History demonstrates that chasing momentum near evident peaks frequently coincides with heightened risk. Entering heavily when sentiment appears universally positive often places capital at the most vulnerable moment. The wiser path emphasizes timeless principles, broad diversification across sectors, geographies, and asset classes, regular, disciplined contributions regardless of short-term conditions, maintaining appropriate allocation based on personal goals and horizon. Long-term perspective serves as the greatest advantage. Markets reward those who view corrections as temporary rather than terminal. Declines create opportunities to acquire quality assets at more reasonable valuations. Preparation further strengthens results. Building adequate cash reserves for emergencies. Avoiding leverage that forces sales at inopportune times. Continuously expanding financial knowledge. Alternative investments offer additional balance. Gold has preserved real purchasing power through every major crisis in modern history. Quality real estate generates income and appreciates over decades. Developed skills and ownership in productive enterprises endure market fluctuations entirely. These elements reduce dependence on any single phase of the equity cycle. They provide stability when paper wealth swings dramatically. The broader insight drawn from generations of market data remains straightforward. Information proximity consistently influences positioning decisions. Those closest to operational realities tend to adjust portfolios proactively when conditions warrant. Observed clusters of activity deserve respectful attention, especially during periods of extended valuations and widespread optimism. They serve as useful contextual signals rather than infallible predictions. Understanding these dynamics helps avoid common behavioral traps. Overconfidence during euphoria, panic during downturns. Instead, it encourages steady, informed approaches that align with proven long-term success. Financial markets continue to evolve. New technologies emerge. Global connections deepen. Innovation drives genuine progress. Periodic adjustments clear excesses and reallocate capital efficiently. The cycle renews itself. Knowledge remains the most powerful equalizer. It transforms apparent disadvantages into structured advantages, turns historical observation into personal strategy. If this examination of recurring market patterns offered valuable perspective, hit subscribe. The answers aren't buried in complex forecasts. They're written plainly in the record of the past.